Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with David Hall, Managing Director of YFM Equity Partners, which manages the British Smaller Companies VCTs. Hello, David.
Hello, Alex.
First off, can you just tell me about YFM and give me an introduction to yourself?
Yeah, sure. YFM was established in Yorkshire, that's what the Y stands for, over 35 years ago as an investor in UK small businesses. And it's focused on the UK regions and has been managing venture capital trusts since the very first wave in 1996. I was born, well, it depends who you talk to. If you talk to my dad, I was raised in Salford. According to my mum, I was born in Manchester. Neither of them are clearly in Yorkshire. And I've been investing in small businesses for 30 years and 18 years with YFM.
So the British Smaller Companies VCTs, they have a huge following. You're opening this year. Why? What are you looking to raise?
Well, this year, so we haven't raised for a number of years, and that's because I think of the amount of funds that we've had to invest. So we like to not have too much cash drag in the VCTs and just raise what we need to be able to invest where we can see the environment. So we've just done some small top-ups for the last 2 or 3 years with a full fundraising this year, which is going to come out prior to Christmas, likely to be in the region of 30 to 35 million pounds.
Do you want to talk to me about your recent investments you've made with last year's raise?
For the last 3 or 4 years, we've been focused entirely on the growth capital investments. And throughout our history, we've had growth capital investments, early stage scale-up businesses in our portfolios. Recently, there are some characteristics which really appeal. And we particularly look at businesses which are looking outside of the UK to expanding markets, with an international appeal for their sales.
Do you want to give me a few examples of those particular companies?
Yeah, there are two in particular, and they've got some common characteristics and some differences. The first is Icon, which is in post-film digital editing. A really interesting marketplace because the marketplace itself is only 7 or 8 years old. And what these guys do is they work on films which have got multiple releases in multiple territories. So in different geographies, they've got different requirements. So if you're watching a Bourne film in France or in Germany, you'll find when Bourne gets a text in France, it's in French, and in Germany, it's in German. So that's a very tight example of the type of business that they are. And what they needed the money for was to expand into the US, to put a new production facility into the US marketplace and put a platform out there, which is an ideal example of scale-up capital. A second example is a business called NCAM, which is in augmented reality. So if you currently, for example, watch football on a Saturday night and watch Match of the Day, you'll find that the 3D dimensional images in there are effectively an augmented reality. They're not actually there. Or if they put a big ball on the pitch, that's not there. So what they're doing is expanding that out into the film marketplace, so particularly with people like Netflix and Amazon. And again, their customer base is international, and therefore, as a result, they're a very outward-looking business.
Clearly you've changed your investment strategy massively because of the rule changes. You can no longer invest in management buyouts. So I've really got 2 questions from that. One, how are you qualified to make these new investment decisions? And also, how easy is it for you to find new opportunities which you think are good?
I think there is something of a misnomer about the difference between a buyout and a growth capital business. As I said at the outset, YFM has been investing in the UK's small businesses for 35 years. Now, some of those have ownership change and some don't. So we can't do the ones now where there is significant ownership change, which is true. And also, I think the bigger change is more towards the fact that the businesses have to be a little younger than they were before. So that's probably the bigger change, where you can now invest in businesses that are less than 10 years old. However, a lot of the businesses that we previously invested in, where there was ownership change, have strong growth characteristics. The one we always get talked about for us is Go Outdoors, but that was effectively 2 shops at the point that we invested, with no systems and no expansion, and that grew to be a 50-shop chain with a sort of 250 million turnover. So it's the characteristics of growth and the ability to penetrate your market and scale your business that are often the things that trip people up. And I guess that's what we've been investing in for a number of years.
And new opportunities?
Yeah, well, the new opportunities is, I think there's an advantage to having been around for 35 years as a business, because you've got quite deep roots in the regions, and in the main, when people are raising money, and we typically invest amounts of less than £10 million, a lot of that is from local advisors looking to raise money locally for their expanding businesses, and whether that business has got a little bit of a buyout in it or more growth capital, right, doesn't really create a difference for those intermediaries. What we have done, though, which is a change in terms of expanding the network, is we've probably gone a little deeper with things like incubator units and private investor networks in the different regions, and probably expanded our touch points.
And are these new rules going to sort of change the profile of your fund in terms of the payouts investors would expect to receive?
I think that's probably one of the biggest changes that we're trying to put across to people, is that the nature of the return profile will be different from the earlier stage growth capital businesses than it is where there is ownership change, which is a function of the type of investment that we make. So the result of that is that I think technically the phrase that we use is more dollopy. So there's one lump of money out and one lump of money back, whereas with the buyout and ownership change element, there is a sort of more consistent return of capital. So I think what that will mean is that you'll probably see dividends tend to vary more over time, whereas historically they've been more consistent. Although there is a transition period, as clearly 70% of our existing portfolio is still in investments which were made pre-November 15 when the rule change came in.
You mentioned earlier Go Outdoors, which was a pretty spectacular exit from a VCT point of view. Have you had any other recent exits which you want to talk about?
Yeah, our most recently, last year, it's a business that I think is quite a good example. It's called Salima, which is payroll software. And I think the interesting thing about that was it was characterised as a buyout, but it was a business which had one piece of software that we had to completely rewrite. We reshaped its customer base and then introduced it a distribution channel both in Europe and overseas. And then we sold that business to a Canadian business that itself, it was actually private equity backed by a US backer of a Canadian business that was consolidating in that sector. And that was a business that had a sort of slightly stuttering start. In the end, it produced a 3.4 times exit multiple at the point that we sold it, which has risen to sort of just over 4 times now with the additional consideration that we received.
Of course, not all companies do well. No. Do you get many failures? And if you do sort of see a company not doing so well, how involved are you? What do you do? Yeah,
it's part of the nature of the risk, and I think one of the advantages that you have with venture capital trusts is you have a portfolio of investments. At any one time you've probably got 35 or 40 investments, and it's true that not all of them will succeed, and we have about one in 5 where there's a sort of less than 1 times capital total return. And I think, though, there are certain things that we look for which to help manage businesses through that process, and part of it is to not let them fail altogether, and therefore when it's not working as well, is to see if we can find a way to crystallize the value at that point before it erodes any further. And I think that, and having networks of people, and over the years we've sold probably 70 or 80 different investments now, you've got lots of different exit routes, and I think you've got to be prepared to be flexible in order to be able to protect the downside as well as capture the upside, which is really important to produce the overall portfolio return.
So finally, David, I'm a very happy British Smaller Companies investor. I want to put more money into VCTs this year. Why should I put some more in your fund?
Well, the first thing I'd say, investing in VCTs I think is a good thing, and investing across the market is a good thing. This year, I would say for our fund, there are probably 3 reasons I would give. The first is performance. Clearly, we've got a long-term performance and track record of investing in UK SMEs that's delivered good returns for investors. The second is that we have, I think, a reputation for being very transparent with our reporting. We're inclusive with our investors. We try and get our investors involved, and it's very much we regard it as a partnership between ourselves and the investors. And the third thing is, I think, is the nature of the businesses in which we invest. growth companies, irrespective of, I think, some of the headwinds that exist in the economy at the moment, can provide a resilience. And typically we invest in businesses which are B2B, business to business, that enable people to work quicker, faster and smarter. And that resilience exists irrespective of the rate or change of economic growth.
David Hall, YFM, thank you very much.
My pleasure.